Real Estate for Breakfast, where McGuireWoods partner Phil Coover brings you essential conversations with leaders in commercial real estate, translating complex industry challenges into actionable insights.
Good morning. This is the Real Estate for Breakfast podcast. I'm your host, Phil Coover, a partner in McGuireWoods in our real estate group. Today we have a good friend, Chris Burns from Quema Capital, to talk about alternative investments. Chris, thanks for coming on the show.
Thanks for having me, Phil.
Chris, tell us, whenever we do a podcast that's about money, it seems to actually get a lot of downloads, a lot of listens. People are always interested in how investing works, how the money works from both the how do I get people to invest in projects and how as a real estate investor can I invest in projects. So I expect this one will be well listened to because it's always interesting and it's hard to find out this type of information. Tell us a little bit about Quema Capital, how you chose the name and what it is.
First off, thank you for pronouncing it correctly. So Quema is a Spanish word. It means burns. I was living in Mexico for about 6 years, so I speak Spanish. So that's kind of part of the derivation for that. I didn't want to name my company Burns Capital. Some people could have a negative connotation about that. So yeah, and there's also alliteration, Quema Capital. So that's where the name comes from. But yeah, we are a broker. I'm an advisor for alternative investments. So that is obviously kind of a broad spectrum. I am with a broker dealer in Chicago called Quema Capital, and they basically have curated a private marketplace for alternative investments. Okay, so I'm one of 120 advisors at Quema, and essentially we give access to and advisory on these alternative investments for individual investors, right? So it's retail access into these alternative investments, institutional grade investments, and yeah, that's what I do.
Let's start with the word broker. I think a lot of the people that are listening to this podcast hear the word broker, they think real estate broker, buying and selling real estate, or they think debt broker, where they're coordinating traditional debt on a project. When you use that term, what are you referring to?
So in the advisory world, in the financial advisory world, there are two paths. There's the broker-dealer path and there's the RIA path. What most people are probably more familiar with is the RIA path. So you have a traditional advisor, you invest some money with them, and they take an AUM fee. So maybe that's 1% of AUM, right? And that's how they get paid. On the broker-dealer side, it's a different structure. It's typically an upfront fee for that particular investment. So what I found is that in general, the products on the broker-dealer side are more interesting, particularly when it comes to growth products. So I do both. So when I say broker, I'm referring to acting in a broker capacity in the broker-dealer side of the business, if that makes sense.
It does. It does. So tell us about the type of alternative investments you have on this platform. And I also want to just kind of flag for people that I think that in the real estate world, there are a lot of folks out there that raise capital for projects, and they may be real estate developers, it might be sponsors of some sort. But what Quema Capital is that you raise capital for you're a professional who's licensed, trained to do this. So it's kind of it's a different level of capital raise than you might see in just sort of, hey, we've got a few folks that want to pass the hat and throw money into the equities of a deal. Probably talk about bigger deals in order for it to make sense on your platform. But yeah, tell us about what type of alternative investments you guys have on there.
Yes. So our platform has a lot of things in the real estate market. So a lot of real estate syndication. So a real estate developer might be looking to build 10 assets around the country, right? So they need capital to do that. So they could, if they're a smaller developer, maybe they could pass the hot hat around. That can go so far. But often what happens is they end up needing a lot more capital than they can get from that process. So they go to the independent broker-dealer market, which we are a part of, which Quema is a part of, to access a broader network of investors. Okay, so we have anything from real estate development deals, typically in a fund structure. There are some single asset deals on there as well. Acquisition funds, so, distressed or opportunistic acquisition funds. We have some private REITs, and then we have kind of direct early stage equity investments, which I've gravitated towards a little bit because I think it's pretty interesting. Private equity funds, some stuff on the credit side, private credit, CLO funds. So we kind of have a pretty broad spectrum, but most of it is in the real estate field.
Yeah. And I think it's pretty cool that you get to learn and have insight into all these different types of businesses and projects that must be just interesting on a day-to-day basis. But the other thing that I just wanted to mention is often with real estate deals, when you build the capital stack, you have your traditional loan. Maybe it's a construction loan if it's a development deal, or just an acquisition loan if it's not a construction deal. And then you need to have you have your capital stack from the sponsor. The capital is being invested by the sponsor who's targeting the deal. And then oftentimes people will need to raise money to fill out the rest of the equity requirement to get to the level of the traditional loan. And so I see people do it, there's a couple different ways. There's the syndication from friends and family, the country club money syndications, so to speak. And that's one path. And then you have sometimes if it's a little bit more and you want to have a big dog in the race, you have a family office or maybe some wealthy investors that take a big slug of the equity. And that can be, everything has its pros and cons, but that can be kind of fast and more streamlined if you can get that. And then you have institutional capital, which you can place maybe like one big institutional source to take up your equity stack. But I think that this is a fourth path that a lot of real estate sponsors don't always consider, is having a platform, having a market that's already built out there where you have a network of investors that are looking for these types of alternative investments, and you have a level of capital that can be invested that way. I think it's like a fourth path that's not considered all that much.
Yeah. And a lot of developers don't even realize it exists. A lot of developers I start talking to, they didn't know this existed. I didn't know this existed before I started in it a couple of years ago. But yeah, if you're thinking about the different ways that you can raise capital, you can go the institutional route. And a lot of the sponsors that we work with do that also, right? But they chose to kind of diversify that raise into the retail broker-dealer market so that they had money coming in from all these different sources, right? And from the retail market, it's a little more of a steady flow than compared to the institutional market, when it can be very chunky, right? People might not be writing checks for a period of time, and then they might be writing a lot of checks for a period of time, et cetera. So with the retail market, it's just kind of a way to get a steadier flow. So a lot of sponsors like that because it helps them be able to plan better.
I guess a lot of sponsors would like that too, just because they don't want to spend their time capital raising and making pitches. They'd rather kind of offload that to a professional.
Well, yes and no, because they still have to end up doing pitches. Someone has to do those pitches, right? So it's not necessarily an easy market to enter into. It's not to be taken lightly because it can be a heavy lift. So you as a sponsor, you basically have 3 levels of sales that you have to make, in this retail market, right? You have to sell the individual broker dealer that you want to work with, and that could be multiple. You could work with 10, 20 different broker dealers. And then you have to sell at the advisor level, so all the advisors at the broker dealer, right? You have to basically pitch them and get them on board. And then the investor, right? So that's 3 different levels. So some of the sponsors do that themselves. Some of them hire an internal wholesaler to do that. Some of them hire external groups who do that as well. So there's different ways that you can do it, but it's not necessarily, you're pitching less. It could be, pitching more. It just depends on how you structure that.
Sure. That's helpful. And then from the investor side, I'm sure there's some comfort in the diligence process that you guys run. How does that work?
Yeah, so I think that's probably one of the biggest value adds that we do, right? Because there's so many different sponsors out there that have individual deals or funds or whatever it might be. And if you're kind of someone who's not that used to this world and you want to get into it, it can be pretty overwhelming, right? You have all this stuff to look at. How do you make sense of it? That's really hard to do especially when you're first getting into it, but pretty much always, right? So we have our internal due diligence team at Great Point. I think they're quite good, right? So they basically filter all of these sponsors and deals that we have on our platform. Okay, so that's one level of diligence. And then there's also another level of diligence at the managing broker dealer level, right? So all these offerings, they have basically a managing broker dealer. They're kind of overseeing the whole raise for that sponsor. And then they sign selling agreements with different broker dealers. So they might sign selling agreements with 10 broker dealers. But the point is that managing broker dealer is also doing their diligence before they sign on to do that deal. So before I see anything, it has gone through two, in my opinion, very good levels of diligence. And then I look at things and I have my own ways to filter it, and I see what would be good for a particular client. But yeah, that's one of the things that I think sets us apart and makes it worth it to go as an individual investor to go through the broker dealer route instead of go around and put some money in the hat, like you mentioned.
Right. Yeah, no, I'm sure if you're an investor with assets to invest, I'm sure you're asked to invest in a lot of projects, and it must be difficult to decide. It's not an endless amount of assets. So you have to, at some point, try to decide which ones you're going to say yes to, which ones you're going to say no to. And so I'm sure they have to build up a level of trust with their broker dealer as to the projects, but then they have a built-in comfort level that it's at least been vetted out in ways that, because to me, I can analyze a real estate deal, but that's just because I live it every single day. A lot of people, it's very foreign to them. Like they hear maybe I've got money in equities, I've got money in bonds, like I want to get into real estate. It's like, well, how? How do I know where to start? So I'm sure there's a lot of value add there.
Yeah. And so, our reputation, Great Point's reputation, my reputation is very important, right? We want to be doing this for many years, right? So we want to be very careful with that whole diligence process, and we want to create a quality brand around all this.
Can we talk about some of the tax advantages? I want you to tell us about the traditional IRA to the Roth IRA conversion and the benefits of doing that. So I'm just going to admit it. The Roth IRA is something that every time someone brings it up, I have like a little level of guilt in my brain that like it's something that I just kind of ignore. And even there could be a commercial on TV that mentions a Roth IRA, and I'll be like, I'll just get like a shudder in the back of my mind because I know it's something that I don't like want to think about or pay attention to.
Yeah.
But when I read your article about the different tax advantages of investing in alternative investments and like how you do that, and then how you convert the funds invested from a self-directed IRA and then convert it to a Roth at the time when the basis is lowered. I don't know. I thought it was really compelling.
Yeah. So before I get into that, I will say that I don't think that people utilize their qualified. By qualified, I mean they're basically their retirement accounts. So that could be their 401k or their IRA or Roth IRA, whatever it is. I don't think those are utilized enough in the ways that they should be utilized in. Meaning they're inherently very illiquid accounts, right? You're not supposed to touch that until 59 and a half. You could with a penalty, but you don't want to pay that penalty, obviously. So they're illiquid in nature, yet I see most people investing into things that have daily liquidity within them. So I don't think that that's necessarily the right approach to do with 100% of that portfolio of those accounts. So I would say I think it is probably worth it for people to look at more illiquid investments that they can get some kind of an illiquidity premium on for those accounts. Okay.
That makes sense.
And so for this thing that you're talking about, you could do a Roth conversion, right? So you can convert from your traditional IRA to your Roth IRA. Okay. You can do that whenever you want. So that is a taxable event, right? So you get taxed on the amount that you convert over. Okay. So if that amount is less, then you're paying less taxes, obviously. And I just want to first also preface, I'm not a CPA, not a tax guy. So you got to check that out with your own CPA. I always work with my client's CPA whenever I'm involving anything like this. So with the one that you're referring to, so with any kind of development deal, right? the value of that deal is typically reduced at the beginning of that cycle. Okay. So you have that aspect. Also, these are securities. These are illiquid securities. So if you wanted to sell those 6 months after you invested into them, there are some secondary markets you could do that in, but you're going to take a haircut on that, right? So if you want to sell it, let's say you invested in something today, you go to sell it in 3 months, you might be taking a 20% haircut. I'm just making that number up, but it's going to be some kind of a discount, right?
The pawn shop of real estate investing, right?
Yes. So there are some of those popping up, and they're becoming bigger, which I think is a good thing, giving people more liquidity. So what these sponsors do is they have an appraiser come in and they value those securities typically within the first year and a half of the project. Okay. So that those securities get valued down. Okay. And then you can convert to your Roth at that lower valuation.
And why do they get valued down?
They get valued down because of the illiquidity of the securities and because it's a brand new project. It's typically dirt with maybe some infrastructure in there, and it's not that valuable at that time. At the beginning of the development cycle, it's not that valuable. Well, it's less valuable than the amount that you invested into it, right? There's a bit of a J curve there, right? So it'll dip down, and then as that project completes, that J curve increases.
Do sponsor fees and kind of closing costs and everything decrease that value right at that moment?
A little bit, but it's more so depreciation, and it's largely the illiquidity of the security, right? So the fact that this is a security that you're investing into and it's not easily tradable, right? That accounts for a large portion of that reduction. Okay. So you're taking some risk, right? By investing into something that's illiquid. Okay. And this is accounting for that risk essentially.
So the value would be that let's just use a base 10 number. You invest 100,000 from your traditional IRA into a real estate development deal, but that 100,000 would be the value of that investment would be reduced on day 10, let's call it, or like the day after you close because of all the reasons that you've mentioned. And so your taxable event is less than it would be if you had just converted it without putting it into a real estate development deal, if you just moved it from traditional to Roth.
Yeah. So let's say hypothetically that gets reduced to 70% of the invested amount, right? So your 100K gets reduced to 70K. You convert to your Roth at that point, right? You're essentially paying 70% of the taxes that you would otherwise if you converted at the 100% level.
Yeah, that's huge.
Yeah, it's pretty powerful.
Yeah, that makes me want to pay more attention to Roth IRA discussions in the future.
All right.
Knowing that there's that value add, that little kicker there. And then do you want to talk about some of the other tax advantage investings that you've written about? You've got an article online. It's actually what sparked our conversation back up a few months ago.
Yes. So a lot of the stuff on our platform is kind of in that tax advantage space, right? So this Roth conversion strategy is a good one. We also have a lot of DSTs, stands for Delaware Statutory Trust. So it's a legal structure in which you can do a 1031 exchange on a securitized passive basis. So we typically see this with older investors or real estate portfolio managers that have their own personal portfolio. And maybe they are actively managing that portfolio. And that's a lot of work. And they've been doing it for a bunch of years and kind of, built up a bunch of value. They want to sell out of that and move into something passive, right? But maybe their gain is going to be so big that they want to avoid getting taxed on that. So they could do a 1031 out of something like that into a DST or into many DSTs, right? So it's a way to diversify. And then those DSTs are professionally managed, right? So this would be a passive investment for that investor, and they could receive some yield on that, and they have not paid the taxes on that gain has not been recognized. There's also some estate planning benefits, right? So because it's in a trust, if there is, if the owner passes away, beneficiaries will receive those units with a step up in basis. So that's a kind of a longer term play there that people can do. So that's a pretty big one. We have a lot of that stuff on our platform. Opportunity zone funds. So this is something that's getting some attention now because of the Trump administration. They're pretty keen on them. There might be some legislation that changes the terms of that this year, hopefully. So an opportunity zone is basically a tract of land that has been deemed an opportunity zone, and investment into that tract receives some tax benefits. So there's two main tax benefits. The first one is a deferral on the gains of whatever you sold out of before you invested into that opportunity zone fund or opportunity zone business. Okay, so that deferral currently goes till 2026, so next year, but payable 2027, right? So that's essentially 2 years from when that tax bill would be due. So that's like a 2-year interest-free loan from the government. I'm hoping that there will be some legislation that bumps that back a little bit, right? So there's rumors that will be bumped back a couple of years. Okay, so that would change that deferral till 2028, payable 2029, right? So that changes that 2-year deferral into a 4-year deferral, which is a little more powerful, obviously. Okay, so that's the first main tax benefit. The second one is if you, the investor, hold that investment for 10 years, then the gains on the qualified opportunity fund or business investment, those gains are eliminated. Okay, so that's pretty big. So that includes, with a lot of these projects are real estate. Not all of them. There's some oil and gas. There's some business ones, but most of them are real estate, typically real estate development deals, right? So these are going to eventually, once they're stabilized, they're going to be kicking off income, right? So income that they generate from rent, they're going to dish that off to the investors, right? So that is offset by depreciation, right? So that the investor doesn't have to pay taxes or as much taxes on those cash flows. Typically what happens at the end of the cycle of one of these investments, it gets sold. The basis has been reduced by the depreciation over those years, right? So then the gain at the end ends up being more. So that's depreciation recapture. That doesn't happen with opportunity zone funds because the basis is stepped up to that sales price. So that's kind of a lesser talked about benefit. But yeah, it's I like to think of it as it's kind of another Roth IRA with more benefits, right? Especially for anyone that's our age or even younger, it's even more beneficial if you're younger. You can invest as much as you want into an opportunity zone fund, right? If you do a Roth, you can only do 7,000. Or there's some other ways, if you do like a SEP IRA or solo 401k, there's a way to put way more in there. But there are still limits to how much you can put into your qualified accounts, right? With the opportunity zone fund, there are no limits on that. Okay, so you can invest millions of dollars into this opportunity zone fund. If you hold it for 10 years, then those gains are eliminated, right? So for anyone that's like our age or younger, it's basically a shorter term Roth IRA with no contribution limits, right? And you get that deferral piece from whatever you sold out of. So, if you sold out of anything in the last 6 months, then you can defer the gains on those for that to hopefully more period.
And people love that. They're often thinking 6 months a year, not 10 years down the line. So having the short-term benefit as well is helpful. Are you seeing a lot of activity? I mean, this was the hottest topic in 2019, 2018. People started talking about 2019. Like I couldn't get through a week without having a conversation about opportunity zones. And then it just sort of was forgotten about for a couple of years. But maybe with the new administration coming back around to put it in place, maybe it's kicked up a little bit. Like, do you have any on your portal?
Yes, so we have a bunch on our platform. We probably have 10 different sponsors that we work with in that space. I have my own portal. So if you go to my website, Quema Capital, if you hit the browse button, then you can go into my portal. So you'd have to create a profile. But then I kind of list off, it's a portion of our overall platform. It's not our whole thing. It's only probably 10, 15% of it, really. But yeah, we have a number of different opportunity zone fund sponsors that we work with. So yeah, it was maybe a little quieter in that 2019, 2020 period. A lot of these sponsors were kind of figuring out how to utilize those, I think. So it's been kind of a learning process for them over the years. And there are some out there that have figured it out pretty well. So I think that they're kind of hitting their stride, and now we're getting some support from the Trump administration. So I think that they will probably be more relevant in the next 5 years or so.
Yeah, interesting. And then, what else are you seeing out there in terms of alternative investments? Like, what are some other great opportunities that you're seeing besides the real estate deals?
Besides the real estate deals.
Yeah, I know we're going off topic from real
Okay.
estate for breakfast, but I was just curious what you're seeing out there, because my world is very real estate limited. But I was wondering if there's a segment or an area that is on fire that you get a lot of calls about.
Well, before we move outside of real estate, let me just kind of talk about a couple of different spaces within real estate that I've been focused on. So real estate development, particularly multifamily and build to rent or SFR development, I think that looks very good moving forward because of where we're at in the cycle. Starts are way down. Obviously, rates have been elevated for the past couple of years. So starts are way down. So if you develop into a market that is seeing a lot of growth, those are going to be delivered in a low supply market, right? So the odds of those investments doing well is higher. The other thing that I've been looking at is more in the opportunistic space, right? So also a lot of these sponsors have had floating rate debt and or too much debt in general, right? So there's some distressed sponsors out there that are needing to unload their assets. Okay. So there are some other sponsors that we work with that have created funds to basically scoop up these assets at really good levels, right? Well below replacement costs, right? So instead of developing to kind of meet that low supply market, you could just acquire well below replacement cost. And as long as it's a strong market, then that's a pretty good trade.
Yeah.
So those are kind of two theses that I've been focused on with my clients and a lot of stuff that I've been doing.
Before you move on sorry, now I'm interested. Before you, like with those types of funds that are trying to acquire distressed assets, are those, I'm going to guess, multifamily kind of in the Southeast that they're targeting? Because there are a lot of people that was a little bit overdeveloped. There's a lot of people invested in those areas at very high basis a few years ago, and debt was cheap, but they might be on floating debt. Exactly. Yeah.
Yeah. So there's some in the Southeast. There's some in Texas. There's some right here in Chicago. I think Chicago is actually a great market for that because there's so little supply projected in Chicago, right? So typically Chicago will deliver around 4,000 new multifamily units a year for the past 12 years or so. That's what they've averaged. But the projection for this year and for next year and 2027 is very low. Okay, so if you can either develop in Chicago or acquire at good prices in Chicago, then I think you should be sitting pretty, right? The year over year rent growth for Chicago is 4.2%, right? So that leads all major markets. I think there were a lot of institutional players that left the Chicago market during, COVID. So a lot of money left Chicago, and that kind of created this void, right? So now there's like no supply, and we have all these issues. And on top of that, there are some distressed sponsors who need to unload some really nice assets, right? So for a sponsor with those connections and the ability to acquire those assets at good levels, that's almost a no-brainer.
Yeah, that's actually what our last guest, Matt Katsaros, was talking about from Wildwood Investments, because he's delivering quite a few units in the next few years. And we were talking exactly about that, just how few units are being delivered over the next few years and how his projects are making up a greater percentage than they normally would. Because, it's usually like 4,000 and they're saying it's going to be like 600 in a year. And so there's just not a lot of supply coming online.
Yeah. I was gonna give Matt a call actually, just because I'm just excited about Chicago market, as I'm sure he is very excited. So yeah, that's very true.
All right, and then get you out of here on what else you're seeing outside of real estate. Like what are some exciting topics?
Yeah, so we from time to time we get some good early stage deals, like in the seed or maybe a venture round or growth round or something like that. So There's one that I like in the pharma market. So, you met that guy or saw him present in my event about a month and a half ago.
Yeah, very interesting.
So there's that one. I can't really talk specifically about those offerings on here.
Yeah, and you don't want to pick favorites. I get it. I was just wondering if there's a market segment that you're seeing a lot of interest in.
I mean, tech. So we have a couple of good tech deals from time to time. So that's obviously, that's no surprise that that's going to be pretty attractive and potentially pretty hot. I will say that I think like the private credit CLO space is probably pretty underutilized by individual investors. And I think that's a good place to look, right? So if you're like a traditional 60-40 portfolio person, I would argue that you could take a chunk of that you have allocated into the bond market, let's say, and put them into private credit or a CLO fund. There are some very good sponsors for those out there. A lot of the big players have funds for both of those. So they're very well managed and you get quarterly. So most of the funds are structured as interval funds. So there's less liquidity than maybe you're used to, but maybe you don't need that liquidity. A lot of them will have quarterly liquidity. So that's probably good enough, I would argue, for most investors. So I think looking at that space is probably pretty good idea. But yeah, I mean, and everything aside from that is kind of like one-off, and I don't want to get too broad with any recommendations or anything there.
Got it. Well, Chris, I really appreciate your time today. Thanks for coming in. Thanks for telling us about Quema Capital and the broker-dealer space, and found it really interesting.
Thanks, Phil. This is fun. Appreciate it.
Thank you for joining us on this episode of Real Estate for Breakfast. To learn more about today's discussion, please email host Phil Coover at pcoover@McGuireWoods.com. We look forward to hearing from you. This series was recorded and is being made available by McGuireWoods for informational purposes only. By accessing this series, you acknowledge that McGuireWoods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this installment. The views, information, or opinions expressed are solely those of the individuals involved and do not necessarily reflect those of McGuireWoods. This series should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.